Let's talk about the speed with which we are watching this market deteriorate.
We're now down 43%.
In 1998, Wall Street got together and bailed out a hedge fund. In 2008, the central banks got together and bailed out Wall Street and all the banks in the world. In the next crisis, who's going to bail out the central banks? Everything about this was corrupt. The bankers got the profits, not the people. This is not left versus right or Republican versus Democrat. This is elites versus everyday people. That's what's going on. Are they trying to wreck the system? No, but they are wrecking the system. They're not uneducated, they're miseducated. We should be descaling the system. Punch a hole in a vessel, one compartment will fill up, but the vessel won't sink. Break up JP Morgan into 5 banks or more. If one of those banks fails, too bad for them, but the whole system doesn't go down. President Bush declared a state of emergency 2 weeks after 9/11. For 16 years, President Bush and President Obama have renewed the state of emergency. America is one phone call from martial law.
We will not tolerate civil disobedience.
We can't save the world. What can we do to save our families? I recommend putting 10% of your investable assets in physical gold and silver. Fascism, properly understood, is not a creature of the right or the left. They're right-wing fascists, but they're also left-wing fascists. Fascism is the elevation of the state.
This week on the show, I am extremely excited to welcome the American financial expert and author of 4 New York Times best-selling books, James Rickards. His latest edition is called The Road to Ruin, and it is the global elite's secret plan for the next financial crisis. And the reason I like James is because he's been there and done that. And he was part of a hedge fund called Long-Term Capital Management that I used to trade derivatives with when I was in Wall Street in the 90s. And he took that fund from $1 billion up to $7 billion, and then the whole thing collapsed. So he's seen what happens when financial markets and traders go wrong. He worked with 2 or 3 Nobel Prize winning professors, a lot of PhDs, but he's seen what happens when things go wrong. And now he's got financial models that sometimes have been able to predict terrorist attacks. He actually predicted Trump winning the presidency based on his financial models, and he's a really, really smart guy. He's also good friends with our friend, Mr. Max Keiser of the Keiser Report. And so he talks about where you should be putting your money. He thinks 10% of it should be in gold, and how you can protect yourself from the next financial crisis. Lots of great stuff here. We have a really peppy, fun conversation, and we talk a little inside baseball when it comes to derivatives, finance, and what us greedy bankers are really like. So I'm sure you're gonna enjoy this interview with James. We inside London Real Academy are now walking through all of our students through the Life Accelerator program, and we are taking control of our mindset, our diets, our fitness, our inner circle of relationships, and we're making 2017 our best year, so you'll see things posted there. As well, inside the Academy, we're going through our Create and Connect cycle as we speak, so join in to a lot of the fun. You'll see our brand new website inside, and come and say hi. And now, I leave you with James Rickards. This is London Real. I am Brian Rose. My guest today is James Rickards, the American financial expert and author of the New York Times bestselling books, The Death of Money, Currency Wars, and The New Case for Gold. You are an advisor for Johns Hopkins University and the U.S. Department of Defense, where you served as a facilitator for the first ever financial war games conducted by the Pentagon. Your new book, The Road to Ruin, outlines the global elite's secret plan for the next financial crisis. James, welcome to London Real.
Thank you, Brian. Great to be with you.
Awesome to have you here. I got tons of questions about the book, about you. But one of the things that really piqued my interest that you went through in your life was that day in 1998 when you sorted out long-term capital management. And the reason I know even who that is because in 1993, I was a derivatives trader at Bankers Trust.
Okay.
And later, I moved to the First National Bank of Chicago, and I remember the emergence of long-term. And it was almost kind of mythical at the time because we heard of these guys that were in Connecticut. I think did you have Myron Scholes?
Myron Scholes, Nobel Prize winner, was one of our partners.
And so like when people get to Wall Street, like the options pricing model is called Black Scholes,
right.
which are after two professors that finally figured out how to price options after the market was doing it kind of incorrectly for 20 years. And then you guys had hired one of those people. Two Nobel Prize winners,
correct.
Right? And it became this kind of mythical institution, and it went, I think, as you said, from $1 billion up to four, and
eventually got to seven. And we
yeah.
gave some back, and when it crashed at the end, it lost $4 billion in about 1 month. But it was an incredible ride. It's exactly what you're describing, Brian. It was just for 5 years, we were the hottest thing out there. There was no talent we couldn't attract, no money that wasn't interested in coming in. Very secretive, very tight-knit culture, enormous success, real results. I mean, we actually did give a $3 billion all-cash dividend to our investors at the end of 1997. So what we did, we tripled their money, gave them $2 back, kept $1, and then lost 92% of the $1. But you still got $2 and change for your initial $1. So most investors actually made money over the life of the fund. Okay. Most of the money that was lost was our money. We had little by little, we had, through our deferred compensation plans and compounding and not charging ourselves fees, we had actually grown to the point where $2.6 billion of the money was our own money. So it was a horrendous loss, but it fell where it should have fallen on the people who were running the fund.
Right, and like you said, at the time, it was this kind of mythological thing. Everybody wanted to do business with you. All the banks opened up their credit lines. Everybody wanted to work for you. And I just remember, knowing about it, and it was this huge success. And like you said, you had amazing returns. I think you did a lot of things in the swap market, a lot of liquid fixed income instruments.
Correct.
That I think you guys, really had some great trading strategies in ARBs. So, I know it really well, that term. And then I remember when it all went wrong in '98, and it just didn't make sense because these were the guys that knew about this stuff. And I believe it was the Russian crisis that made the swap spreads go really wide that caused a bit of a liquidity crisis and made things happen, right?
That's exactly right. It was interesting because in my new book, The Road to Ruin, I talk about this. By the way, there's a whole chapter on this. This is the first insider account that's ever been written. There have been other books written about long-term capital. One in particular came out in 2000 by Roger Lowenstein. It's called When Genius Failed. An excellent book, by the way, and I talked to Roger, helped him with that at the time the book came out. But he did hundreds of interviews with all the Wall Street participants. But there's never been an insider account written by somebody who was actually there. So mine is the first one, and it's one of the chapters in The Road to Ruin.
Yeah, chapter 4, I think.
Right, exactly.
And you were general counsel?
Right, and I was the lawyer. I did compliance and all that, but you talk about all these derivatives contracts. I was not the trader. I was not the quant. I wasn't sitting there with formulas pricing things. We had plenty of people to do that, including Myron Scholes, the co-inventor of the Black-Scholes formula. Right. By the way, there were 3 professors responsible for that. It was Fischer, Black, Myron Scholes, and Robert Merton of Harvard.
Yes.
So it might have been called Black-Scholes Merton, but Bob was actually a very, very generous guy. Fischer and Myron had kind of worked out their formula, but there was a really difficult, challenging piece of math involving something called Ito's calculus, a branch of calculus they couldn't quite solve. They went to Bob Merton. Merton solved it. He said, okay, you guys publish the paper, take credit for it, and then I'll do another paper later on, which was pretty generous of Bob to let Fischer and Myron do that. So when they awarded the Nobel Prize, now sadly, Fischer Black died, and the Nobel Prize is never awarded posthumously. You have to be alive.
Okay.
So they awarded it to Merton and Scholes. Scholes and Merton were the joint recipients of the Nobel Prize. They were both partners at Long-Term Capital. And what they did, actually, again, very generous, they took the money, they pooled it, carved out a third, and gave that to Fischer Black's widow. They didn't have to do that, but they felt that was the right thing to do. So I always thought that was a very admirable way to handle the prize money.
Wow.
But yeah, we had 2 recipients of the Nobel Prize and 2 of the 3 founders of, that formula is at the root of all derivatives pricing, because futures are really just a form of options. Everything, futures, forwards, options, they all involve optionality, like betting whether the market's going to go up or down. So that formula is at the base of all of it.
Yeah, it's such a huge formula, and for many, many years, people were estimating it incorrectly,
Correct.
Calculating it incorrectly. And so I went to MIT. That's one of the reasons I was recruited there by
Right.
Bankers Trust, to get a bunch of these rocket sciences in to try to price these derivatives. And I don't know if you remember Bankers Trust back in '93.
I absolutely do. I started banking in '78.
Okay, gotcha. So Bankers Trust, we didn't have the pedigree. We weren't Goldman, we weren't JP, but it was this scrappy bank full of a bunch of smart people that didn't mind taking risk and putting on all sorts of fascinating derivatives trades. And I got on the fixed income book in 1993, and it was the craziest thing. I was 22 years old.
Right.
I just passed my Series 7, and I got on the desk, and the guy gave me a phone, and he said, "This is the phone to Chicago, where you will trade futures. This is the box to the Treasury desk,
Right.
and you are now trading swaps."
Yeah.
And I was just like, "You mean now?" And they're like, "Now." And next to me sat all of the exotic option desks, and they were doing time trades, which
Yeah.
were daily options, and they were at the cutting edge of some of these really crazy derivatives.
Well, a swap is just a leveraged bond trade without the bond.
Correct.
When you buy a bond, you finance it in the repo market. So I buy the bond, and then I pledge it to get cash. That's the repo, and I use the cash to buy another bond, and so on. So you build up this pyramid of bonds and repos, and then so you're receiving a fixed return on the bond, and you're paying a floating return on the repo. So somebody said, well, why don't I do a contract with you where I receive fixed and pay floating, but we'll skip the bond.
Yeah.
That's what a swap was.
Yeah.
And so it was kind of invisible, but you had cash flows, and you could profit or loss according to that, but there was no actual bond, and it was off balance sheet. And today, Brian, as you know, there are $1 quadrillion notional derivative of swaps of the kind we're talking about. For the viewers, 1 quadrillion is 1,000 trillion. That's how much is out there. So this is a monster that's completely out of control.
Right, and what James is really talking about, this off-balance sheet property means that it doesn't show up anywhere.
Right.
And now look, I traded derivatives for about 5 years, and I broke credit derivatives here in London for 10 years afterwards. So like, I'm a derivatives guy. And I still believe, well, there are some great things about derivative contracts, but the problem is that you can't tell where they are and who belongs to what. And so you can do a massive amount of leverage where the usual risk controls wouldn't see that, say, long-term was holding the equivalent of $1 trillion worth of bonds.
Correct.
And so look, when used correctly, they are valuable instruments, but they can also get a little out of control.
Well, I would disagree a lot. I would say they're a lot out of control. I would say that derivatives were, and in my book I actually go through 3 crises. So 1998, which is the one we started talking about with long-term capital management. 2008, I think the viewers are very familiar with that. Everyone lost money in 2008,
Right.
so they don't need to be reminded
Yeah.
of that. And then those were 10 years apart, 98 and 2008. So I hypothesized a third crisis in 2018. So I talked about 98, 2008, 2018. Although I make the point that it could be tomorrow, that the setup is there. 2018 is kind of a device to talk about the next crisis, but it could be sooner or later, it could be tomorrow for that matter. Now, in 1998, Wall Street got together and bailed out a hedge fund. In 2008, the central banks got together and bailed out Wall Street and all the banks in the world. In the next crisis, who's going to bail out the central banks? In other words, each crisis gets bigger than the one before. Each bailout gets bigger than the one before. We are now at the point where the central banks can no longer bail out the system because they are stretched to the limit. I'll use our U.S. Federal Reserve, our central bank, but this is true of central banks around the world. They took their balance sheet from $800 billion to $4.2 trillion to bail out the crisis the last time. And there's, by the way, more than that, because they also did $10 trillion of swaps, invisible swaps with the currency swaps with the European Central Bank, guaranteed every bank deposit in America, guaranteed every money market fund in America, took interest rates to 0. I mean, the measures were extraordinary. Now, it did truncate the crisis. It would have been a lot worse if they hadn't done that. But they haven't normalized. In other words, if somehow in the meantime, in the last 8 years, they got their balance sheet back down to $800 billion and got interest rates up to 2.5%, I'd be the first one to say, nice job, guys. You saved the system, You got your balance sheet back to normal, nice going. But that didn't happen. They're still at 4 trillion. Interest rates are still close to zero. When the next crisis comes, and it could come tomorrow, it could come any day, they're not going to have the capacity to deal with it because they're stretched as far as they can. Now, some people, Stephanie Kelton, Paul McCulley, some of the modern monetary theorists say, what's the problem? Just go to 8 trillion or 12 trillion, print as much money as you need. I don't believe that's possible. Legally, it is possible, but politically, they'll encounter resistance, they'll lose their independence. And there's also an invisible psychological boundary. You will destroy confidence. You will cross that boundary. You won't know until it's too late. Yeah. So the central banks can no longer bail out the system. The only clean balance sheet left in the world is the International Monetary Fund. They're not that highly leveraged. They can print money. They have this world money, this special drawing right, the SDRs. They give it a funny name so people won't know what it is, but I just call it world money because that's what it is.
Do they have the assets that can allow them to bail out?
They can print this money. That's the point.
So it's the last institution left with any kind of credit.
Or printing power, I'll put it that way. So clean balance sheet and others. So the Federal Reserve can print dollars. The ECB can print euros. And the IMF can print these special drawing rights. Now, I dare say no one knows what these are, and why should they? It's this highly specialized. I mean, I've met PhDs in international economics who can't give you a straight answer as to what an SDR is, but I obviously have studied it and I've trained in this, so I'm pretty familiar with it. But that's what they'll do because there won't be any other source of liquidity. And then that'll be the end of the dollar as the benchmark global reserve currency. We'll still have dollars, they'll still be around, but they'll be like Mexican pesos.
Because there's no confidence anymore.
Correct.
Because it ultimately is about confidence, right?
Absolutely.
And that's what people need to understand. And like you said, the powder's not dry anymore for the Federal Reserve. And so as they get levered and levered and levered, at some point, it won't work anymore when they go out of bail.
That's exactly right.
And it is this confidence issue until everyone says, wait a second, this can't work. And that's when everything falls out.
You've got it exactly right.
And once you lose it, you can't go back.
Look, you're right. Once confidence is fragile, it's easily lost, and once you lose it, you can't get it back again. It really goes back to the fundamental question, Brian. What is money? Okay. So at various times and places, feathers have been money, clamshells have been money, dollars and euros are money today, gold and silver have been money. I would say they still are. I would say they're the best form of money. Debit cards, credit cards, and Bitcoin is money. I don't own Bitcoin. I don't recommend Bitcoin, but I would say that it's a form of money. And people go, well, it's not backed by anything. You know, the dollar is not backed by anything. The euro is not backed by anything. Bitcoin's not backed by anything. I say, no, they're all backed by one thing, which is confidence. If you and I think it's money, if you're willing to accept it from me because you're confident you can give it to someone else for goods and services, then it's money. But what happens when the confidence goes away? That's the point.
Yeah, there's a great book out now, I think it's one of the best sellers, called Sapiens, and it just talks about all of these institutions that we have faith in as people. They're just figments of our imagination,
right.
Whether it's the Queen or the USA or money,
right.
Or Ford Motor Company. And it's a belief until it's plainly obvious it's not anymore.
Right.
And when that happens, the bottom falls out.
The emperor has no clothes. I mean, the classic fairy tale or children's story, but it's exactly how things work.
Right. And now for people to understand, if we go back at these 10-year cycles, and I think they're really interesting to look at it that way, in 1998, why was long-term bailed out? Just so people know, you've got a lot of derivatives on the books. You're about to fail. You're going to lose all of your money.
Correct.
Now, why did the banks have to come in to bail this hedge fund in Connecticut out with all these smart, rich guys that'll probably still be rich again?
Right. And that's the point. I mean, without mentioning names, like let's just say that some individual was worth $300 million on paper because that was their share of long-term capital. Well, we lost 90%, so now you're down to 30 million. Not a hardship case. You're still worth 30 million. I know you're right. These people were not going on welfare. I like to say that if we actually had failed and we were prepared to file for bankruptcy, we were days away. I would have just slept in the next day. It would have been Wall Street's problem, and that's the point. Wall Street did not bail us out; they bailed themselves out because we owe them the $1.3 trillion notional value of derivative contracts. Now, if you're Bear Stearns or your old firm Bankers Trust or Credit Suisse or any of the other firms that are involved, so you write the contract with long-term capital management, and then you write the offsetting contract with some other, commercial hedger or some other bank, okay? And you're just sitting there taking a little spread. You're like, okay, I'm receiving fixed and paying floating over here, and I'm receiving floating and paying fixed over here, and I'm making a little spread, and I've got a lot of leverage, and I'm making 20% returns on equity, and it's all good. Well, the minute one side goes away, the minute this contract goes away, which is what happens in bankruptcy, you've got a one-sided position. This is like, instead of having a spread trade, you're net long or short, whatever it is, you have to go out in the market and cover that position. This is what was going to happen, that Wall Street collectively, I call the 14 families, after the mafia.
14 families.
These 14 families,
right.
We're going to have to go out and cover $1 trillion of stuff, treasury bonds, and I'll never forget the Sunday before the bailout. So this was all happening in real time. So I was the lawyer. So I
You're the guy that stayed up for 5 days in a row.
I stayed up 5 days in a row.
Getting all this stuff done.
Negotiated this. I mean, there were teams of lawyers around, but I was in charge of our side of the deal. So before the consortium, that's what they called themselves, came together, a delegation from the Fed and the Treasury came up. So it was Peter Fischer from the Federal Reserve Bank of New York, his deputy Dino Cost, and a guy named Gary Gensler, who was Assistant Secretary of the Treasury at the time. So the Treasury and the Fed come to Greenwich, Connecticut. They sit down. John Merriweather, called him JM, as our founder and CEO.
Was this former Salomon Brothers?
He was the vice chairman of Salomon
right,
Brothers.
so another huge name that went out there.
In the 80s, he was the master of the universe.
He wrote books about him.
Correct. Liar's Poker, which is Michael Lewis's first. Michael Lewis has had a string of bestsellers, but his first bestseller, Liar's Poker, was about JM and this hand of Liar's Poker. You play with the numbers on the serial number on a bill. That supposedly $1 million bet between John Goodfriend, the CEO, and John Merriweather, the vice chairman of Salomon Brothers, on the trading floor, and that's how the book starts. But John Merriweather was also kind of the model for Sherman McCoy and Bonfire of the Vanities, Tom Wolfe's novels. He was the master of the universe. A really nice guy, by the way. But
the bond trader on the floor, not afraid to take risks.
Absolutely. But the difference was that at Salomon Brothers, they were a unit within a much larger firm. Now, the firm had to disclose their overall results, but they didn't have to break down the results of that unit. So these guys they could lose $200 million one quarter and make $400 million the next quarter. And so you're up $200 million, which is pretty good. But that one quarter where they lost the $200 million, nobody knew about it because it got buried in these much larger results.
And a huge balance sheet.
Correct. The problem, when they got to long term, if you lost money, everybody knew about it because we didn't have any other businesses that we were in. And so that was that. When we got to the acute stage later on, that's what happened. But the point being, so it's JM and me and two guys from the Fed and the Treasury, and we sit down. We didn't ask for a bailout. We called them to let them know what was going on. It was almost like good corporate citizens, like, okay, this plane's going to crash. We just want to warn the people on the ground that the plane's crashing. But we didn't really expect them to bail us out. So we said, let's just tell you what's going on. We just sat there. We had printouts. I mean, we had computers, obviously, but this was all printout. We just spent a whole day going page by page. When we were done, Peter Fischer's face was white. And Peter's a very solid guy. He's seen it all. And what shocked him, he looked at us and said, I knew you guys were going to destroy the bond market. I didn't know you were going to destroy the equity markets because we had $5 billion of equity trades. We were the biggest name in risk arbitrage. That's when you bet on takeovers.
Yeah,
it was
I didn't know you guys were doing risk.
It was all in. We were the biggest. It was all in derivative form, with Bear Stearns. So Bear Stearns gave us what's called a basket swap, and we could just call up and say, you put in some Citigroup, sell some Lockheed, all the big deals at the time, MCI WorldCom, Citicorp Travelers, Boeing Lockheed, all those big merger arb deals in the summer of '98. We were in all of them in size, but it was just a contract with Bear Stearns. So Bear Stearns would go out so they would sell us, Citigroup or whatever the target was in derivative form, but then they would go out and buy it themselves.
Yeah.
So they would have a covered position. Well, if we went bankrupt and that swap went away, they were going to have to dump that stock because they were just net long. They didn't have the capital for that. So there was going to be a $5 billion wave of panic selling in the stock market on top of the bond market. So
that's a mess. Then it's mom and pop, it's pension funds,
Correct.
And then everybody feels the volatility.
They would have closed the markets, at least temporarily, just to get some orders. This is what we were up against. So my point, Brian, is that Wall Street didn't bail us out. They took over our balance sheet so they wouldn't have to have the fire sale, which would have bankrupted them. Right. Now, the exact same thing happened in 2008. We were hours away, or probably days away, a couple days away at most, from the sequential collapse of every bank in the world. So Bear Stearns had failed in March of 2008. Fannie Mae and Freddie Mac, the big mortgage agencies, failed in June and July of 2008. Lehman Brothers failed in September of 2008. They were falling like dominoes. They were going like this.
And then Merrill.
Morgan Stanley would have been next, then Merrill, then Goldman, then B of A, then Citi, then JP Morgan might have been the last guy standing, but they all would have fallen. Same thing around the world, Deutsche Bank, Barclays, and all the rest. So you can see
I got a call Sunday night in my house in '08 saying, "Are you coming in the office?" from my clients at JP Morgan, Credit Suisse, or whatever. And I knew things were bad, but I'd watching the Lehman equity go down to zero.
Sure.
But I didn't know Lehman had failed.
Yeah.
And so I was like, why would I come in the office on a Sunday night? And they're like, because we are about to start liquidating contracts. Because like you're saying, when you miss a counterparty, all of a sudden all these contracts that look like fairly low risk hedge instruments, everyone has to start going in and liquidating.
Right, and this is exactly the point, which is that all of the risk models that Wall Street uses, and you're familiar with them because you traded this stuff, this value at risk. So you go to Jamie Dimon, and let's say he's doubled his derivatives book, which they have since 2008. And you go,
this is the president of JP Morgan.
He's the CEO of JP Morgan. So you go to Jamie and say, okay, you've doubled your derivatives book. How much did the risk go up? And he would say, well, very little, because it's long, short, long, short, long, short, long, short, all nets out, comes down to this tiny little thing. We get a little capital, but this is value at risk, right? But that is not how you measure risk in derivatives, because that only works when everything's good. But when you're in stress and people are going bankrupt, all of a sudden the net becomes the gross, exactly what we just explained, which is you take a counterparty out of the equation, your net exposure now is a gross exposure, and then it's liquidating the gross or covering the gross that causes the illiquidity in the markets, causes the panic. So why they are allowed to get away with providing capital using value at risk when that is not the proper measure of the risk, it astounds me, but that's the system we have.
Right, and in '08, they were saying here in London, RBS was like hours away from shutting down ATM machines, which I think people don't really understand. When people can't go to the ATM machine is where you get real panic.
Right.
And you get humans behaving in ways we haven't seen them behave in probably hundreds of years.
Right.
And that's when there is no confidence anymore and scary things happen. Are you amazed that we made it through '08 without more social unrest?
Well, given the magnitude of the response, no, although we would have had the social unrest if it had been allowed to continue. But the way I analyze it, Brian, and we just talked about the flaws in value at risk. The models that are used, equilibrium models, normally distributed risk, that means that the degree distribution of events is a bell curve.
Yes. Standard models on Wall Street.
Efficient markets, all the information.
Markets,
prices move continuously, so if I want to get out, I can, it might be worse price, but I can always get out. Every one of those assumptions is wrong. Empirically wrong. That's not an opinion. If you actually look at the degree distribution of risk, it's not a bell curve. It's what's called a power curve, a different shaped curve, which represents a completely different system. Prices don't move continuously. They gap up and down. There's no chance to get out anywhere in between. Markets are not efficient. They do crazy, irrational things all the time. And all the assumptions of modern finance are incorrect. And yet, we've built this 1 quadrillion inverted pyramid of derivatives on flawed models. We shouldn't be surprised that these things keep happening. But the point I'm making is, and you're exactly right about the dynamics in '98 and 2008, in the next crisis, we're going to have the same dynamics on a larger scale. The central banks will not be able to truncate it as they did in 2008. And it's going to take 6 or 8 months for the IMF to issue these SDRs. They're slow. They're not a nimble organization. And they're going to have to lock down the system. They're going to have to shut down the system. Money market funds are going to suspend redemptions. Banks are going to be closed. ATMs will be reprogrammed. Give you maybe.
So it's like Colombia, basically.
Or India today.
Or India, where you can't get your money out
Correct.
unless we let you.
Right.
So
or Cyprus or Greece. I mean, this is happening.
Right. It's
more
happened
and
in
more.
Cyprus.
Right.
Yeah.
It's coming to Europe. It's coming to the UK, and it's coming to the US.
It almost turns into this weird pseudo-socialist communist system where you don't own your assets anymore, or you can redeem your assets when we decide to let you.
Right. Well, it could be socialist. That's one description of it. And I have a chapter on socialism in my book, but it will end up being neo-fascist. And the reason I say that, and by the way, fascism, properly understood, is not a creature of the right or the left. They're right-wing fascists, but they're also left-wing fascists. Fascism is the elevation of the state. Mussolini's definition of fascism was everything within the state, nothing outside the state. There's no civic society, there's no individual, everything is in the state. That can come from the left or the right. But the point is, when you lock down the system and when you reprogram the ATMs and say, hey, you can have 300 pounds a day for gas and groceries. Why do you need more than that? That's enough for gas and groceries. We'll get back to you about the rest of your money, but that's your allowance. People will riot. They'll start to burn things down. They'll break into banks, et cetera. They'll break into supermarkets. And then there'll be a militarized response, a neo-fascist response, because states don't go down without a fight. So that's how this will play out.
Right, and then that just gets worse and worse.
Correct.
Right. Okay. And so just to recap, the '08 crisis, when I think a lot of people don't understand the bailout, people are bailing out themselves.
Exactly.
We're bailing out our own system so we don't have more pain down the road.
Exactly.
And so, okay, and as long as people understand that. So this next crisis coming, maybe 18, maybe tomorrow.
Maybe tomorrow.
But it's coming.
Right.
And you went, after long-term capital, after you wrapped that thing up and put it to bed, you went back and restudied markets. And
Right.
you realized that they weren't these beautiful stochastic systems that we wanted to model. And again, these derivative instruments, they're very young, right?
Yep.
They're 20 years old, 25 years old.
Well, that's a very important point, because so I was the lawyer, so I did my job. We negotiated the bailout, we got it done. By the way, everyone went on with their lives. I mean, there were no enforcement actions, no lawsuits, nobody got a slap on the wrist, everybody had a clean record, everybody went back to business. The back office at Long-Term Capital Management moved like 2 towns away from Greenwich to Harrison, New York, started a firm called Globop, a hedge fund administrator, sold it for $1 billion, 10 years later. So,
Story of Wall Street.
Myron's, yeah, it's,
Everyone always surfaces.
F. Scott Fischer said there are no second acts in American life, but there are plenty of second acts. And Myron Scholes started a $1 billion hedge fund. JM started another hedge fund. I went on to start a couple funds and do other things. But my point being, that life went on, but as a lawyer, I say, okay, I did my job. Like we did the bailout, everyone moves on, nobody's disqualified from anything. But as just a person, and I lost money personally in it, I was part of this. I was very dissatisfied because there was no dishonesty. I mean, it was just really bad mathematics and bad risk management, right?
Yeah.
So, and these guys were trustworthy, but they didn't understand risk. So I said, well, wait a second. They actually are the smartest people around. They all had 160, 170 IQs. They were way smarter than I am. They had the Nobel Prizes. They had the PhDs. We had 16 PhDs. I said, okay, if the smartest people in finance got it wrong, the whole thing must be wrong. It can't be that they were unlucky or they're stupid, because they weren't stupid. So there must be flaws in these models. So I spent 5 years studying physics, applied mathematics, network theory, graph theory, behavioral psychology, complexity theory, a variety of fields to understand what was wrong. And I found it. I discovered what was wrong. That didn't take too long. What did take longer was, okay, this doesn't work. What does work? How can we understand capital markets? And this is where I kind of part ways with Nassim Taleb, the author of The Black Swan. So Taleb writes this book, The Black Swan, and he demolishes the bell curve. He just takes a baseball bat and he bludgeons the bell curve to death, And he should. That's good for some things, but it's not good for finance.
Yeah, as in the bell curve isn't an accurate representation of events in general.
Events, the degree of distribution of events. That's
Right,
exactly
the normal
right.
distribution.
It's not even close,
Okay.
but it mimics it sometimes, which is what confuses people. So he destroys that. But then he throws up his hands and says, "You can't use math. I'm a philosopher. I'm going back to Lebanon. See you later." And he's like, so it's like, no, Nassim. It's like, I got to the same point he did, and I've never read his book, of course. And it's like, yeah, you're right about the bell curve, but we don't have to throw up our hands. We have to keep trying. And so then I spent another 5 years developing these models. And interestingly, around the same time, I was recruited by the CIA to help out with counterterrorism, because there was insider trading in advance of the 9/11 attack. That's obvious. The last 2 trading days before 9/11, there was 286 times the average daily volume of put buying on American Airlines. When you buy a put, it's a bet that the airline's going to go down. So that's like statistically, that's like a guy who orders a sandwich for lunch every day, and then one day he orders 286 sandwiches. Well, it's not him. There's something going on. And that's been well studied. And what the CIA said is, okay, I mean, it wasn't their job to run that down. That was the FBI and the SEC had to go find the bad guys there. But what the CIA said was, okay, if there were another spectacular attack being planned, a 9/11 style attack being planned, would there be insider trading again? Could you detect it? Could you trace it to the source, get a FISA warrant, break down the door, break up the attack, and save lives? That was our mission. We called that Project Prophecy. Now, CIA, they didn't any help spying, but they didn't have the capital markets expertise. So they reached out. They're very good when they know what they don't know. When they don't know something, they'll reach out. So I was one of the people invited in to bring in the capital markets expertise to help them figure this out. And over time, I actually got more and more involved, became a co-project manager, and ended up, along with a couple others, leading this Project Prophecy. And we answered all the questions. We said, yeah, there will be insider trading. You can spot it. You can't. We we built a system to detect that. But in the course of doing that, pardon me, I learned statistical techniques that I wasn't familiar with as a lawyer. Because I wasn't, as I say, I wasn't a trader or a quant, including Bayes' theorem, sometimes called causal inference, and complexity theory. Well, the more I got immersed in that, the more I realized that that could be applied to other things. We were using it for counterterrorism, but it could be used for predictive analytics in geopolitics and predictive analytics in capital markets, normal politics. I was in Australia, New York, a week before the U.S. election, saying Trump's going to win and getting laughed at in my face.
Yeah,
but
you did predict
I have all the videotapes. The great thing about doing television, you get the timestamp videotape so you can prove it. But I was using this Bayes' theorem. I was using statistical method to make that forecast. It wasn't just because I was a partisan. I was like, no, there's very good evidence that he was going to win. Same thing with Brexit. I was in the London Eye on June 20th saying short sterling, buy gold, because I could see that the markets were priced for Remain, and if Leave wins, you got to reprice those two things. And so we're getting very good results with this. So I went on this 10-year intellectual odyssey to figure out what works. I did it, and pardon me. So that's the methodology I've been using, and I talk about it all in the book. I explain it all, and it's not, there are a few equations, but it's not heavy on the quant stuff. It's pretty plain English.
Were you ever able to predict any terrorist attacks based on the financial markets? I mean, I guess you probably couldn't tell me if you did.
Well, we did spot one, because it was broken up. It was August 2006, and it was being executed here in London. This was the liquid bomb plot, and the plot was they were going to smuggle they could make the explosives using two different liquids. So you take two different bottles on the plane, combine them, set off.
I remember that. I flew to Italy that day.
And blow up the plane in midair.
Yeah.
And they were trying to blow up 10 planes, mostly bound for New York. So they would have killed everyone, but mostly targeting Americans. So it might have killed 3,000 Americans because they were looking at Delta, American Airlines, and British Airways and others. Well, that MI5 in New Scotland Yard took that plot down. I believe it was a Wednesday morning, early Wednesday or Thursday. I have to check the exact date. It was like August 10th, 2006. The Sunday before, I'm sitting at home, and I'm a little bit of a night owl, so it was about 2 o'clock in the morning. And that's when they took down the plot. But a couple days before that, my colleague, Christina Ray, called me. She said, Jim, I'm getting a bright red on American Airlines right now. We had a red, yellow, greens, green, all good, yellow, keep an eye on it, red, looks like insider trading. We had built this system. She says, I'm getting a bright red on the market.
Based on options trades, or even just the stock volatility?
A lot of things. Volatility, volume, momentum, options, skew. It was a multi-factor formula using the kind of Bayes statistical methodology that I've been describing. She goes, I got a bright red on Americans. So we escalated that, and this is the part I can't talk about, like kind of how that goes up the chain. But a day went by, 2 days went by, and nothing happened, and we're like, okay, well, maybe it was a false positive. We can't really, go any further with that. And then the next day, MI5 took down that plot. Now, I'm not saying we called MI5, and they were onto that plot anyway. They got information from ISI, Pakistani intelligence, CIA, MI6. They all collaborated on this. My point was our system was detecting a plot in motion, and once there was one key arrest that was made in Pakistan, and then when that happened, the Pakistani arm of the terror cell called London and said, start the attack, because they're taking us down, so get the attack going. And then that's when the insider trading took place that we saw on our system, and then, as I say, the plot was taken. But this was a plot in motion, but we got the bright red on the insider trading.
Right, and the theory is that there's enough people involved in this attack, and some of them are greedy.
Correct.
Or maybe someone that overheard them are greedy, and so the information gets out, and somebody wants to play some bets.
That's exactly right. And I actually, within the CIA, I encountered a lot of skepticism when I outlined this methodology. They said, oh no, the terrorists would never compromise operational security by doing insider trading. This is a complete waste of time. And I said, look, nobody's saying Mohammed Atta, on his way to Logan Airport to hijack the plane, stopped off at Charles Schwab to put in a few trades. That's not what happened. It's your point, Brian, that these terrorists operate within a social network. Everybody has a mother, father, sister, brother, cousin, neighbor, safe house operator, driver, etc. And some of those people are greedy, cannot resist the impulse to bet on a sure thing. So I had a two-word answer whenever I encountered this skepticism. I said, Martha Stewart. Because Martha Stewart was a legitimate billionaire. Martha Stewart made $1 billion legitimately. She was a very successful business person, but she ends up behind bars on a $100,000 trade. If you're a billionaire, why do you care about 100,000? But people cannot resist the temptation to bet on a sure thing.
Right.
So the trading does happen, and then once it happens, you can spot it.
Right, and if people don't know the whole story with Martha Stewart, like you said, legitimate billionaire, she was caught doing a tiny insider trade.
Yeah.
You know, yeah, it was something really...
Just to be clear, she didn't actually go to jail for insider trading. It was related to an alleged insider trade, and I think there was some other kind of cover-up, just to be fair to her. But it was definitely, it involved insider stock trading, even though that was not the precise conviction. But she ended up behind bars for 100 grand, basically.
Yeah, and humans do funny things.
Correct.
And that's why I believe the U.S. has managed to block, I think, most of the terrorism efforts on its soil, because when you get more than 3 or 4 people, just loose lips usually happen. And there's these lone wolf attacks, but usually when it's more than a few people, they end up talking to a mole that's in the CIA, and a lot of times it's
FBI or whatever.
Which is interesting. So now you can look at these financial liquid markets and you can be like, okay, something funny is happening here.
But what I'm doing now is using the same techniques that I studied or learned at CIA, and that we actually built. We built this system, and then using it on my own to basically do forecasting and geopolitical forecasting and forecasting in markets.
Okay. Now, you knew that this subtitle was going to get some people's attention. The global elite secret plan for the next financial crisis.
Right.
Now, what are you saying about the global elites? Are they doing certain things before this crisis, as far as stockpiling cash, doing certain things with their trades? And are they doing this because they know better, or are they conspiring with each other? And what can we learn from what you know?
Great. Well, I don't think it's a conspiracy in the sense that there's a small group of Illuminati wearing hooded robes sitting around a mahogany table like a scene of Spectre from a James Bond movie. It doesn't work that way.
But of course, you used to hang out with those Illuminati in Greenwich, Connecticut. We'll get to that later.
That's another story. So, but the way it does work, and I talk about this in the book. First of all, it's not a secret. We know who they are. It's Christine Lagarde, her first head of the IMF, her first deputy managing director, David Lipton. Professors like Larry Summers and Ken Rogoff at Harvard, public intellectuals here in the UK, Adair Turner, Anatol Koletsky, Mario Draghi, head of the European Central Bank. So it's a collection of central bankers, finance ministers, academics, think tankers, and public intellectuals, and several hundred of them around the world who collectively run the international monetary system, because they either run the central banks or the multilateral institutions, or they're in and out of finance ministries, or they have a lot of influence. So that's who they are.
They influence 90% of what happens,
or more. Exactly.
Okay. So there's no secret that it's some other guy.
We know who they are. Okay. So then what about the hooded robes part? And the answer is, they don't need that. You just said conspiracies fall apart, and they do. Conspiracies are kind of easy to spot most of the time. It's more the case that they're like-minded individuals. They don't need top-down organization because they all agree with each other. They all went to the same schools. They went to Oxford, Cambridge, MIT, Harvard, Chicago, Stanford, like 6 or 7 schools in the whole world. They all went to them. In many cases, they were each other's PhD thesis advisors. Stanley Fischer is the vice chairman of the Federal Reserve, former MIT professor, a little older than the rest. He was
slamming my alumnus here.
Look, I know a lot of these guys. I mean, I kind of know whereof I speak. As I say, I hung out with the 16 PhDs and the 2 Nobel Prize winners at Long-Term Capital. I shared an office with Myron Scholes for 6 years, so I know this milieu. But Stanley was the thesis advisor to a lot of the other central bankers. So they're not only like-minded, they taught each other. And they all learned the same thing, and it's all wrong. They're not uneducated. They're miseducated. In other words, the models that they have taught themselves, that they perpetuate and that they're teaching to the younger scholars, are at best obsolete and at worst dangerously flawed in ways that are setting up the system for this new crisis that'll be worse than the last 2. So they're in control. They're like-minded, so they don't need a lot of coordination because they all think alike. They've got badly flawed models. And they never see this coming. So are they trying to wreck the system? No, but they are wrecking the system through their own kind of ignorance and misapprehension of the statistical properties of risk. Meanwhile, they are smart enough to know what we're describing, which is that this is going to happen again. They can see it coming. They don't actually understand why, but they know that nothing got fixed in 2008. One way to think about this, Brian, is that the dynamics and the mathematics of a financial panic are exactly the same as the collapse of any complex system anywhere in the natural world. So earthquakes, volcanoes, forest fires, various phenomena, avalanches of this kind. They're not just metaphors. I mean, I use them as metaphors in writing, but they're not just metaphors. The dynamics are identical, but with one difference, which is in a man-made system, you can truncate it with policy. In a natural system, you cannot. So when an earthquake starts, what's an earthquake? An earthquake is a release of energy. That's how you define and measure an earthquake. When an earthquake starts, you can't stop it. Like, you can't stop an earthquake in the middle and say, time out. But if you could, imagine if you could, what would happen? That energy would be unreleased, but it would still be there. The pressure would be there building up. It just didn't get released that time. Now bring that over to the man-made systems. There, when the earthquake starts, when the release of energy starts, you can truncate it. So you have dominoes falling, boom, 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 boom. You know that the last one's going to fall unless they drop a steel wall between two dominoes. Now the domino hits when the next one doesn't fall. That's what they did in September of 2008.
Right.
They dropped a steel wall between Lehman Brothers and Morgan Stanley didn't fail, but because they guaranteed every bank deposit, money market fund, and currency swap in the world.
When they should have let it fail, or nature would have let it fail?
Well, they should have let it fail. Now, I don't think we should have allowed ourselves to go into something worse than the Great Depression. There was a solution on the table that they never pursued because of cronyism. See, now we're getting into the gangster side of it, the cronyism side. So what they should have done, by executive order, and the legal authority was there, they could have nationalized all the big banks. Not permanently, because I'm not in favor of socialism, but temporarily nationalize them.
And cleaned them up.
What you do is you wipe out the equity. First of all, you rip out the bad assets, and you put them over here in trust for the American people. So it might take 20 years to sell them, but whenever we sell them, that money goes to you, the taxpayers. Over here, we now have a clean bank. Equity, you're wiped out. Bondholders, how big's the hole in the balance sheet? 20% haircut, 40% haircut, whatever it takes. Preferred stock, you're probably wiped out. Put the losses where they should be. Put the losses on the people who deserve it, which are the stakeholders in the institution. So now you get rid of the bad assets, you wipe out the equity, you now IPO a clean bank to raise new equity, and you start over with Citibank and Goldman, all these guys private, with new owners and clean balance sheets, and we can get the economy moving again.
Continue watching this fascinating conversation for free by clicking on the link below to visit our website, and I'll see you on the inside.
Sometimes I feel like an anthropologist who goes out in the jungle to this exotic tribe of monetary elites, studies them, comes back to civilization, and explains them in plain English. I mean, part of what I do is read these, you're 24 layers deep on the IMF website. There's some technical paper full of jargon. I'm enough of a geek that I read it and I understand it, and I can tell people what they're doing. Tell them the SDR is coming, the end of the dollar is coming, this lockdown plan is already in place. The U.S. is operating under state of emergency. How many people know that? President Bush declared a state of emergency 2 weeks after 9/11. Understandable, but by law it has to be renewed annually. For 16 years, President Bush and President Obama have renewed the state of emergency. America is one phone call from martial law. So these are all the things I see. So this is what I'm telling people in the book, so they don't have to be victims.